getting some cold weather finally. Yes. No more heat. No more 80 degrees. Yes. I'm excited. Oh my God, I'm excited. I missed y'all. How y'all doing? Yay! Cold weather. Okay, that was my excitement for the day. Hey, I hope everybody had a great week. And, as I always tell you, no matter if your week was good, bad, or indifferent, it's okay. Just don't stay in that space. Get out of that space because you've made it. God blessed you to see another day, and we are here, period. So don't stay in that space. So as you know, I like to kick off the show with fun facts. And it took me a minute to think about the fun fact that I wanted to do today. And so happened was I was walking and I happened to see somebody with a coffee cup. And that just really, really rubbed me the wrong way. And I don't know why, not in a bad way, but it's like, does everybody drink coffee? Nobody likes tea anymore. Nobody likes juice anymore. Like, what is so up with this coffee thing? And I was like, I'm going to do my fun facts on coffee. Why not, right? So let me tell you about coffee. Maybe if you're a coffee drinker, you already know, but I don't know. So I had to go do some research, right? So coffee is a beverage brewed from roasted ground coffee beans. Well, of course, where else would it come from, right? Because you can grind it up. They got the cute little grinders and it smells so good, right? So what else couldn't you do, right? Coffee was discovered in Ethiopia by a goat herder who noticed his goats' energetic behavior after eating the fruit from the coffee plants. So this goat herder saw his goats going all over, just hyper, and he noticed it was off coffee. Now, I love ice cream. I wonder if they would have went crazy like that if it was ice cream. One day I'm going to go meet a goat and give him some ice cream and see. Now, what we call beans are actually the seeds of these fruits, and darker roasts contain less caffeine than lighter roasts. Now, that's something I did not know. So the darker, the higher, the lower is no caffeine, but it's coffee. Like, no, for me, but nothing against coffee drinkers. The world's largest cup of coffee, according to the Guinness World Records, contained over 26,739 liters and was made in Guadalajara, Mexico on December 10th, 2022. Over 2.25 billion cups of coffee are consumed daily, which equates to roughly 820 billion cups a year. That's a lot of coffee. That's a lot of coffee. Like if I had 1 penny for everybody that drank a cup of coffee, I would be rich. I think that's what I'm going to do. I'm going to walk up to somebody and ask them if they drink coffee. And if they say yes, I'm going to ask them, let me have a penny. And I'm going to count them and see how many I get. And I'm going to be rich off this. Watch what I tell you. Now, coffee is the most popular drink worldwide, second to water. I'm glad to know water is still first. Glad. Because coffee is taking over. It's coming in and taking over. Tea is not even on the bracket. Like, no one likes tea. Like, I love tea. So, that's all I have for you coffee lovers. I wish you nothing but the best and success with dark roast, light roast. I don't know the difference because I don't drink it, but I love the smell. So hopefully, I'll become rich asking everybody for a penny off this coffee, right? So now we are in November and we are celebrating birthdays. And my guest today, his wife just celebrated her birthday on the 4th. So happy birthday, Mrs. Brittany Owens. Yes. And rest in peace to my grandmother. We'll be celebrating her birthday November 17th. Please don't forget to love, like, share, and comment on the content. I can't stress this enough, world. This is free information, and you just never know who needs to hear free information. You never know who you're helping, because again, a lot of people keep things to themselves and they don't talk out loud about it. And sometimes you really just don't want everybody in your business, regardless to what it is. Now, I have an important announcement to make. Excluding today, we have 10 more days for anyone to participate in the amnesty program through the Illinois Department of Revenue. Shavonna, what are you talking about? So, if you have any prior tax debts from June 30th, 2018 to July 1st, 2024, and you owe the state of Illinois, if you pay the actual tax that's owed, they will wipe away any interest and penalties. So let's assume for tax year 2019, your tax debt is $500, but you owe $900. That's interest and penalties. Well, guess what? If you pay that $500, they're going to remove that other $400. This ends on November 17th. So again, if you have a tax debt and you want to clear that tax debt, you have exactly 10 more days excluding today. That's very, very, very important, my people. Very important. So I'm going to start with my disclaimers for today because, as you know, we got an excellent show. We're going to be learning about money. Who not excited about money? Didn't the OJs, wasn't that them? Money, 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 money. Oh, money. That's what all of us going to be singing after this show, right? Okay. So today our phone lines are going to be open. The phone number is 312-837-7219. When calling in, please state your name and where you are calling from. We're going to ask that you be mindful of the time. We want to give everybody a chance to ask questions, bring insight, so one caller can't take up the whole show. However, we are going to leave important information at the end of the show for you to contact our special guest today. Now, the information that we're going to be sharing is information and educational purposes. Be mindful and diligent how you pass on the information, which it comes from a reliable source, right? So what I will tell you is, because I've been talking about the show for so long, I've had so many people say, Shavonna, I can't make the show. Shavonna, I can't make the show. And even though I say you can go on YouTube and watch it, no. What if I have a question? What if this? What if that? So what Let's Talk Finance is going to be doing, we're going to be covering these topics more often with our featured guests. And we're going to be talking about IRAs, mutual funds, investments, retirement planning, insurance, and just everything. Like, this brother is so smart and knows so much. I don't understand how his brain can hold all of that. I just don't understand. Stay tuned for upcoming sessions, and it's going to be designed to help you grow, plan, and secure your financial future. Take notes, everybody. Please take notes, because that shows that you are paying attention. You don't want to miss anything. And guess what? If you're subscribed to the YouTube channel, you can always go back and watch it and press pause. Then guess what? I bet it's something else you didn't know. You're going to have our featured guest contact information. So if you got a question, you can call and ask. I bet you didn't even know that. But it's okay. I'm here to help you out because I'm Shavonna. No doubt. Now, so I've been saying my guest, and y'all know his name because I've been talking about him, but y'all know how I do it on Let's Talk Finance, right? So I want to say I met my guest about 4 years ago. And everybody that know me know that I take Uber and Lyft or the bus everywhere. Wherever I'm going, I will hop on the bus, the train, or an Uber. So I met this gentleman. He came and picked me up and we got to talking. So I give him my business card, let him know I'm an accountant. I do taxes, anything under the financial umbrella. And he tells me, well, I deal with investments. And I'm looking at him like, do I look like I got some money? Do I look like I can invest anything? I don't care about that. I'm trying to help you, but you're insulting me. And, I wasn't ready to receive the information at that time. But it's okay. We all make mistakes. But what I loved about Mr. Owens, he was so diligent. Once I gave him my information, he consistently contacted me. And it wasn't on an everyday basis. He spread it out, maybe every 4 to 6 months, maybe sometimes 8 months. But he remained consistent. He stayed on me. He stayed in the frontal lobe, this part up here, right up here. He stayed there. And I respected that about him because that told me that he was about his business and he was about educating and helping people grow financially. So without further ado, y'all know I like to do things backwards. I am going to bring my guest on camera and then I'm going to give y'all some highlights and then I'm going to get him the show and he going to take over. And then we're going to be asking questions and learning and becoming rich by investing. Okay. So I want everybody to get ready and help me welcome Mr. James Owen. As you see, I'm always hyper. So this is Mr. Owens. This is who I have been diligently talking about and spreading all over social media. So I'm going to give you some highlights that I have about Mr. Owens. First highlight that is so spectacular and that stands out even above his certifications. He was born in Chicago. It don't get no better. He's a Chicagoan, yes, in Riverdale. He has always had a fascination with understanding money and has had an entrepreneurial spirit since 2005. That's 20 years. That's 20 years. 2005, I was still in the club scene. I wasn't thinking about no money. He is driven and obsessed with teaching others about mutual funds, stocks, bonds, and retirement. He's passionate about God and serves faithfully in his church, bringing faith and purpose to everything he does. Now, I'm going to backtrack. That's the first important thing. Anytime you got God in your life, you can't go wrong. So that's number one. And then number two would be he's from Chicago because it don't get no better than that. God, Chicago. Like, no, it's right there. God, Chicago. He's a devoted husband and father, showing us the importance of family alongside financial wellness. So you have a man of God that has an entrepreneurial spirit, that is an entrepreneur, teaching about finances, helping you grow, being a father, being attentive to his family and his wife. It don't get no better than that, y'all. Like, it just don't get no better than that. He's highly licensed and certified, life insurance license. He has FERNA licenses, Series 6, 63, and 26. Now, when he told me that, I said, okay, like, I know what it was. Nope. Guess who did some research? Me. Boom. Let me tell you what it is. FERNA, which is FINRA. That's Financial Industry Regulatory Authority. They regulate the security industry to protect investors and maintain market integrity. Series 6 allows James to sell financial products like mutual funds, variable annuities, and UITs. Series 63 allows him to solicit orders for securities in other states. So not just in Illinois, he can go to a whole nother state, y'all. Like, come on. Like, I'm excited about this. So I can say I'm investing, and the person that I invest through, he ain't even in Chicago. I can make up any state because I know he can practice there. Now, Series 26 empowers him to supervise, manage sales of certain investment products. He is currently working on Series 65. He'll be fully licensed to give professional investment advice for fees as an investment advisor representative. And today you are going to learn that plus so much more. Mr. Owens, did I leave anything out?
I'm surprised you got everything.
Look, that took me some time. I had to work on that. So, you guys, I'm going to move off air. He's going to take over this whole show. Like, I want you guys to get ready to be enlightened and get ready for what's about to happen, because some things are about to happen. Let me get set up for y'all, because I'm excited. I love learning. And when you're learning about money and you're in your field, and it's just exciting. So I'm going to shut up and move and give it on to Mr. Owens. Mr. Owens, you got the flow.
All right. Facebook friends, what is going on? So right now you are tuning into the Financial Wellness Advocate, and welcome to Mutual Funds 101. So those that are looking at my live feed, if you all can go to my pinned post and you can click on that link, then you'll be able to see everything that's being shared on the screen. All right, so with that being said, let's go ahead and get started. All right, so this is basically how I give a mutual fund presentation. Now, I understand that we're talking about money and retirement, mutual fund stocks, all of that good stuff. But I don't like going in too heavy, like too serious when we talk about this. So, I want us to have fun with this. I want us to loosen up, and I just really want you also to learn a lot. So, to kick it off, when I usually do workshops, this is kind of like my icebreaker, so I always ask, what's this name this clip. Now, since I'm not really standing in front of anyone, I usually give people maybe like 5 or 10 seconds, to tell me what clip it is.
If you're tuning in and you want to participate, drop your comments in or call in to 312-837-7219.
Yeah, thank you for that.
I got you.
Appreciate it. So, for those of you all who say a house party, that's actually incorrect. The name of this clip is actually called Class Act. So, if you all remember, that's Wedge right in the middle. That's the school bully. And then you got Kid that's right there on the right side, and then that's his girlfriend. I can't remember her name for nothing. So if anyone got the answer, I'll just go ahead and comment. But remember, Kid and Play, their identities accidentally got switched up by mistake, which is how he ended up in that position. So, what does this got to do with stocks? What does this got to do with mutual funds and money? Well, absolutely nothing. I just thought it was pretty funny to throw up. However, on a more serious note, I want you all to take a look at Kid's face. So you see how scared he looks, right? Just look at the fear. How many of you all can relate that same kind of fear when it comes to your retirement? Not knowing if you even have the correct advice. Not knowing if you're on track to accumulate enough money so where you can not worry about running out of money. These are real fears when it comes to your money, okay? So here's a fun fact right here. Did you know that the wealthiest 1% controls more than $41.5 trillion, and that the top 1% of Americans have about 16 times more wealth than the bottom 50%? And that comes from CNBC.com, June 23rd, 2021, okay? It's a real thing. They pretty much already, Shavana already covered my intro, so I could pretty much skip this, but I'll give you an opportunity to tell you all my story in about like 2 minutes. So I coined myself as the Financial Wellness Advocate because I'm not only just obsessed about learning this stuff, but I'm obsessed about, teaching people not to go through a lot of mistakes that, people make early on in their life. So if anyone has ever experienced an anxiety attack, can definitely relate to where I'm coming from on this. So I experienced my first one on a Saturday, the day before Mother's Day, back in, May of 2024. So that day, we just kicking it, chilling, having a good time. Mentally, I'm feeling fine. Physically, I'm feeling fine. I stepped out on the back porch for about 30 seconds. Next thing I know, my whole body just shut down on me out of nowhere. I didn't even sense it coming. Okay, this is real talk. So I ended up collapsing on the ground. My speech was cut off. I couldn't even scream and yell for help. My body was shaking real hard. You probably thought I was having a seizure. Shaking real hard, heart rate through the roof, hot, cold at the same time. Couldn't even walk, couldn't do nothing. The only thing I can do was like see and hear. That was it. So I ended up going to the hospital. I was in there for I don't know how long. Don't even remember what hospital I was at. I don't even remember getting into the ambulance. That's how bad it was. Kind of found out it was just a severe panic attack, otherwise known as an anxiety attack, okay? So to this date, I've experienced anywhere between maybe like 35 to 40 altogether. The first 2 was really severe that it put me into the hospital. The rest of them was more mild or like in the middle. But I say that because I was going through that because it was a lot of financial stress that I was going through. There was a lot of things going on in that household, and that buildup of stress is just what end up causing it. So I understand from a mentality point, just going through the financial situations and just living it. And I just want you all to know that it's going to be okay. All right, so I'm here to help everyone to eliminate, some of those fears when it comes to building up your financial house. All right, so today's objectives, I got quite a few here. We are going to financially empower you, okay? We're going to financially educate you and hopefully put you all into a position where you can have a full understanding on exactly what a mutual fund is and how you can benefit so that you can increase your liquid net worth to at least $1 million or above, okay? By doing so, that's going to move you into that top 4%, and out of that 95% of retirees that retire with less than 1 million, okay? So you move to that top 4% where you have anywhere between 1 to 5 million liquid net worth, all right? Invested. So as an advocate, I made it my mission and my purpose to help you eliminate the fear of retiring broke, again, because that's a real thing. So we're going to teach you how to employ your money, because if your money is not invested, it's unemployed. I'm going to show you how to put your money to work hard, if not harder for you. And I'm also going to create a customized financial wellness game plan for you, complimentary, okay? So free 99.
Y'all heard that, free 99. So if I was y'all, I would listen.
All right, so I'm getting ready to share with you all what formal education does not teach you, but what self-education has taught me about what the wealthy does to increase their assets, all right? So is everybody down for that?
Me.
So I'm gonna kick it off with the rule of 72. This is a concept that Albert Einstein actually came up with. So he discovered that if you took the number 72 and you divide that by whatever your interest rate is, that'll approximate the number of years that it takes for your money to double. So let's look at an illustration of how this concept works. Let's say, for example, you have $10,000 and you invested it into 3 different positions. We're going to look at treasury bills as the first example. So treasury bills historically has averaged 3% rate of return ever since 1926. So if you take 3% and you divide that into 72, that answer comes out to 24 years. So that 3% is letting you know that it's going to take 24 years for your money to double one time. Now, if you look over a total of 48 years, you can see that your money has multiplied 2 times and it grew to about 40 grand, okay? Now, if we double the rate of return, logically thinking, we might think that our bottom line would double also. But here's where compound interest plays its role at. So at 6%, this is like what the bond market averages in terms of municipal or corporate bonds. At 6%, your money is doubling every 12 years now. So if you look over 48 years total, your money multiplies 4 times, and your market value will go to about 160. Now, 160 is appropriate for certain types of investments, depending on what your goals are. However, when it comes to retirement, 160 is nowhere near enough to live off of, okay? So let's look at what the stock market would do. So 12% averaging. You want to take 12% and divide that into 72. Now your money's doubling every 6 years. So if you look at over 48 years total, your money doubles or multiplies 8 times. And that 10 grand grew to about $2.5 million. So if you notice, It's the same money, same time frame. It's just in a different position. Now, if you look at banks, the average bank savings account will yield you about 0.4% rate of return nationwide. Now, I'm not downplaying banks at all. Okay, we need them; they serve their purpose. But if you want to accumulate and grow wealth, then the banks isn't where you want to keep your money at. Okay. So what I'm simply showing you is how to bypass the middleman, meaning like those normal financial institutions, and put your money directly into the market because that's where it's going at anyway. So when you do business with the banks, credit unions, even life insurance companies, which that's another conversation to have, then your money's going to end up looking like this over here on the left, as far as your retirement, or at least that's what it'll feel like.
$1.11.
Yeah, you balling. Not. So you walk into a bank to open up your standard checking and savings account, right? And you speak with a personal banker. Well, if you want to open up an investment account, then you need to walk into a broker dealer or an investment advisory firm, and you will sit down with a licensed registered representative or a licensed investment advisor representative. So if you bring us aboard and you do business with us, then your retirement could look a little something like that.
Woohoo! Woo!
And as I said before, if you're not investing your money, then your money is unemployed. So I didn't really learn this stuff until like my early 20s, and understand that information really isn't too available like that. But that's why I'm here doing this now. So you don't want to put yourself in this full position where you're paying a high cost of waiting to invest. Okay, so speaking of that, I'm gonna go over an example. So let's just say you started off investing $338 a month, and you started off at age 25. Okay, this is just an example. Okay, so you're investing from age 25 to 60, so that's 35 years total. And let's just say even throughout all the negative years in the market averaged 9%. At that rate, your money will go to a little bit over $1 million. Okay, if you wait just 1 year, starting off at age 26 all the way to 60. So now you're invested for 34 years versus 35. Your market value only grows to $911,000, which means you just missed out on about $89,000 that could have been in your investments portfolio because you waited 1 year. If you continue to procrastinate and you wait 5 years total, meaning you started off at age 30, so you only investing for 30 years, your market value only grows to about $623,000, which means you just missed out on $378,000 that could have been in your account.
So I got a question.
Go ahead.
What happens if you don't start investing until you almost 50? That number is gonna quadruple at that point. So is it even worth investing?
Yeah, it definitely is. If you want to live a comfortable retirement.
So you're saying even with me waiting, even with this negative 378,000, I'm still able to have an investment and live comfortably.
So what you would have to do in that case, you would have to be more aggressive, and you have to put more money up in your investments to kind of catch up.
Okay, so you playing catch up basically.
Basically, yes.
Got it.
Yep.
Where was you at when I was 25?
All right. Now, if you decide to keep coming up with excuses, saying, "Oh, I don't want to invest," or "I'm just going to continue to wait," and you wait 15 years, so now you started off at age 40, meaning you only invested for 20 years, your market value only grows to $227,000. You just missed out on $774,000. All right, so don't pay the high cost of waiting. So my question is, how long can you afford to just keep thinking about it? That's a real question.
I'm tired of thinking about it at this point because I feel like I done lost so many years.
Yeah, because of that compounding interest effect.
Right. And a lot of us don't know or wasn't privy to this information when it was out there, or was it even available for us at that time?
Right. Yeah, so I remember just growing up, my mom used to always take me to the bank, but that was all I was taught, the bank. I knew nothing about investment firms, broker dealers, register. I knew none of that stuff. All I knew was the bank and life insurance companies and burial insurance. That's what I was brought up on. So it's up to us to help to get this information out there so we can better prepare our people. Okay, because this is a real thing. It's too many people that's retiring and they're running out of money. Okay, so this is very serious. All right, so now we're going to get into the actual mutual fund. So when you all hear that word, I want you all to picture this. I want you to picture a large circle with a whole bunch of companies stuffed inside of it. Now, outside of that circle of companies, you have a whole bunch of individual investors, just like you and I. So this actually represents a pooled asset, okay, of many different investors. So as we invest our money into these funds, our money is being diversified and spread across all of those companies at the same time. So what you're actually doing is you're buying shares of the mutual fund. So it's a whole bunch of publicly traded companies, and this is a publicly traded mutual fund. Okay. Now, these mutual funds are always under the supervision consistently by the money managers. These are the like the fund experts or the investment advisor representatives. What their job is for managing the funds. They're responsible for choosing which stocks to or bonds to buy and sell, how much to do it for, when to do it, and doing like a lot of research on the company. So they understand like the analyticals and the financials of all these companies. That's what they do. So most mutual funds own anywhere between 50 to 200 stocks. Now, if you remember companies like, was it Radio Shack, Circuit City, and there's one more that I can't think of. Radio Shack, Circuit City, and Blockbuster. Two things that those three companies have in common is that they were publicly traded at one point. Second thing is they're no longer in business. So even if you were investing into individual stocks, even like several of them, but you were invested to a company like that went out of business, then you just lost most of all your money. It's gone. However, with a mutual fund, which is a lot less riskier, because you're working with on average 50 to 200 different companies at once, even if some of those companies went out of business, your money's still good. The only way you can lose all your money inside of a mutual fund is if all of those companies with that specific fund goes out of business at around the same time. And as far as I know, no one has ever lost all of their money inside of a fund. Never in the history of never. Okay? So mutual funds has been around since July 15, 1924. That's when the original and oldest mutual fund was created. And it's still in existence today. So even throughout all of the ups and downs in the economy, positive and negative markets, that specific fund has averaged over 9% rate of return. Now, understanding that the market does go up and down, mutual funds will experience a negative year on average 1 out of every 4 years. So that means that the market will be down 1 quarter at a time. So if you look on the other side of that coin, that means that the market's going to be up 3 quarters at a time, or 75%. So if you're sitting there wondering how much money does it take to open up one of these accounts, one of these investment accounts, check it out. If you only got $25 a month minimum, you can open up a mutual fund. If you're a corporation and you're looking for like a 401k, or if you're looking to like change vendors, all the way up to a maximum of $25 million, we can implement a 401k for your business. Okay. So that is a mutual fund right there. And if anyone has any questions, go ahead and drop your questions or comments in the comment section. Okay. I'll try to answer them off of my feed as they come in. Or if they can go on Shavana's feed and comment in that section as well.
And our phone lines are open. You can give us a call at 312-837-7219.
All right, so I'm going to give you a couple of reasons why you want to invest into mutual funds and also when to use them. So the first one, I pretty much already hit on that, but diversification. Never put all your eggs in the one basket. That's when you're investing into like individual stocks, okay? Mutual funds, again, that diversified in themselves. You have several companies you're working with amongst several different industries, geographical locations, and sectors, okay? The second reason is professional money managers along with their research team. So I'm going to be direct with you. When I open up a mutual fund or even a variable annuity, I am not the person that's managing your funds, okay? That is the job of the investment advisor representatives, okay? They're the one that's doing all the research on all of the companies, understanding PE ratios, understanding just everything about the company. I'm not doing all that. My responsibility as the registered representative is to physically open up the account for you, answer any questions that you may have, understand your risk tolerance, design a portfolio that's suitable for your needs, and your risk tolerance. Okay, that's my job. And then thirdly is liquidity, meaning you got to be able to easily get to your money. So since your bank account and your investment accounts are wired together, and you get to a point where you want to sell your shares, this is where you're withdrawing from your funds. Realistically, that money will be put back into your checking account within 72 hours. Okay, so it's not going to hit it right away. All right, so that's liquidity. Now, when I am designing your portfolio, I'm always going to open up three accounts minimum. So you're going to have a short term, you're going to have a mid-term, and you're going to have a long-term account. So your short term is your emergency fund. So the whole goal of your emergency fund is to build up at least 6 months of your monthly expenses. Now, you generally don't want to touch this account for maybe like 2 to 3 years, just to allow compound interest to do its thing, okay? But if you needed to get to your money, it's a non-qualified account, no penalties, you can get to it with no problem. But that's why you always want to have at least like 3 to 6 months of expenses in your bank savings account too. So you have immediate emergency access right there, okay? The second account will be your midterm account. So this is for future goals that you have like in the next 1 to 5 years. So this is a non-retirement and non-emergency fund. So a couple of examples. You're looking to put a down payment on a new house or maybe on a new car. Maybe you want to start up a new business, okay, as an entrepreneur. Or maybe you just want to take a couple of extended vacations. Those type of funds will fund that account, okay? And then you have your long-term account. So this is where your retirement or your IRAs will come in at, okay? So I'm going to spend a little bit of time on this section before I move on to the next. So I'm specifically talking about the Roth IRAs, traditional IRAs. If anyone out there is a registered LLC or a sole proprietorship, or maybe a S Corp or a C Corp, and you have fewer than 100 employees in your business, you could qualify to open up a simple or a SEP IRA, okay? And I'll define what those are. And then when you get to the point where you're maxing out those IRAs and you still have a lot more money needed in retirement, then we can start talking about non-qualified variable annuities or index-linked variable annuities. Okay, so that's like the next step. Or if you have at least maybe like $250,000 or more to invest and you don't want to invest into a mutual fund, then we can talk about separately managed accounts, okay? So those are just the different types of investment vehicles. So since the segment is on IRAs, I'm going to spend some time on this part. So in regards to Roth and traditional IRAs, they have a lot of similarities, but they also have their differences too. So here's the main things that they have in common and how they differ. So in regards to how much you can contribute to a Roth or traditional, they're exactly the same. Meaning you can max out at $7,000 per year if you're 49 years or younger. Now, if you're 50 and older, the IRS allows like an extra $1,000 catch up. So you can invest up to max out at $8,000 per year if you're 50 and older. They both grow tax deferred, so you don't have to worry about paying taxes, as you're investing to it. You just only have to worry about that in retirement. Now, with the Roth IRA, this is 100% tax-free. So not only does it grow tax deferred, but even off of the earnings, while you're in retirement, you can withdraw from it 100% tax-free. Now, the way to qualify for a Roth IRA is if your modified adjustable gross income qualifies for you to do so, and that depends on your tax status, okay, or your filing status. So depending on if you're head of household or if you file a single, or if you're married filing jointly, or if you're married filing separately, all of these numbers are different. Okay, so you just got to go on the IRS website and look up those numbers. Matter of fact, Shavana actually posted this recently, I think about 2 days ago. So you can just look up on her page, and I actually shared it on mine as well, and it'll show you the exact numbers. So there's no confusion there. And then if you got any confusion, just go to your tax pro. Okay, they'll definitely help you out with that as well. Now, for those that makes over that threshold, whatever that number is, and you no longer qualify for a Roth IRA, you have to contribute to a traditional IRA. Now, there are two different types of traditional IRAs, and I'm mainly going to stick with the deductible traditional IRA. Okay, so with the traditional IRA, this one is taxable. Okay, it still grows tax deferred just like the Roth. Only once you hit retirement and you're ready to distribute those funds, they are taxable at your marginal tax rate. Okay, whatever that tax rate is. It was one more point that I was getting ready to make, but I can't remember what it was though. Yeah, so that's pretty much it for the Roths and the traditionals. Now, let me go into simple IRAs. So that's actually an acronym. So simple IRA, this is for my entrepreneurs, okay? So anyone that has like a registered LLC or S corp, something like that. This is designed for you. So simple IRA stands for Savings Incentive Match Plan for Employees. Okay, Savings Incentive Match Plan for Employees. That's what a simple IRA is. So with your simple IRA, you can contribute, actually, I believe it's 16 and a half grand per year if you're 49 and younger. If you're 50 and older, then you can max out at 20 grand per year. Okay, so those are the numbers right there. So they have higher contribution limits versus your Roth and traditionals. Now, but if you're going to open up a simple IRA, even if you're the only employer in your company, you have to do a match. Okay, so this automatically comes with it. So you can either do a 2% non-elective contribution, or you can do the 3% match, meaning if either yourself or your employees actually use the investment account. So with the 2% non-elective, they don't invest into it. You would just invest 2% of their salary into their IRA, which is also tax deductible to you as the business owner. So by doing that, that's going to lower your modified adjustable gross income, and hopefully it'll still put you in a range where you could also open up and max out a Roth IRA. So for anyone that's like a newer entrepreneur and you have a business and you do not have a business retirement plan established, it'll make sense. It's a good strategy to open up the simple, again, where you would get that tax deduction, and then you can also open up the Roth IRA. So that's a good strategy to have. So legally, you can do both. Now, with the SEP IRA, that stands for Simplified Employee Pension. Now, this one you can max out at $70,000 per year, or 25% of whatever your salary is, whichever one is lower. Okay. So with the SEP IRA, again, you can make higher contribution levels, and then the age 49 to 50, it doesn't apply to this one at all. Okay, so you don't have to worry about your age. If you make enough to where you can max out at 70,000, max it out at 70,000. Now, at that point, depending on how much your income is, you might not be able to qualify for a Roth anymore. So what you can do is, if you did have the simple IRA already opened up, you could just roll over those assets from your simple IRA into and open up a SEP IRA. All right, that way you can keep everything going, and by performing the rollover, it doesn't create a tax consequence for you, so you don't have to worry about paying taxes. All right, so again, that's another strategy that you can use. So I think that's pretty much all I got on the IRAs. Shabana, did you have any questions in regards to that?
If you have an LLC, I would advise you. I would definitely advise you to start investing, like really, especially if you're trying to bring on employees. And I think what a lot of our entrepreneurs that have LLCs, they're not aware of all the laws that factor into that. Right. And one of those laws are, like you touched on, is you have to pay yourself. Mm-hmm. You have to be on a payroll. Yes. And with you being on a payroll and you having them employees, of course, your AGI is going to drop, because that is a tax write-off for you. And all business owners love tax write-offs. Absolutely. All of us do. I know I look for write-offs. So I think it's very, very prudent to start looking into these accounts, especially if you're an LLC, depending on your bottom line numbers. You mentioned sole proprietorships as well as C Corps as well. Mm-hmm. I'm a C Corp. However, I don't have any employees. Okay. So it would be more beneficial if I did the Roth or the traditional. Yeah. Just depending on your income. If you're within that threshold where you can qualify for the Roth, do the Roth, because it's tax free. Mm-hmm. Take advantage of that.
And then you also open up either a simple or a SEP IRA. No, it's your choice.
When I get the employees.
You don't have to have employees. You could be the only employee.
Right, which means I have to be reporting a salary because you have to show that there's an employee on staff.
Yeah, so you'll be the employee, and it has to be W-2.
Yeah, okay.
Yeah, it has to be W-2.
Yes.
So out of your corporate account, you generate all your profits through your business, and then you're going to take some of those profits and pay yourself a salary.
Absolutely.
As a W-2 wage employee. And that's how you be able to do the process.
Got it.
Yep.
I think that's very beneficial. Very beneficial for business owners. Like, really. Because a lot of this is not there. And people don't think about this when they are opening businesses. What they see is, let me open up a S Corp or a sole proprietorship, and now let me open up an LLC because my cousin went and got one and he making money, so I'm gonna open up one and I can get money. When it's more to it than just that.
Yeah. So I think we make it too much of a habit of establishing businesses. We walk into a bank, we open up that account, but we never think about the retirement. So if as an employee, you want that job and you automatically think of 401k. But you are the business owner now. You got to open up your own retirement plan.
Yes, because you have, and being an LLC, a lot of times people don't know that even though you have an LLC, if you're not filing out on Form 1120S, which means you haven't petitioned the federal government to file out as an S Corp, you're still filing out on Form 1040, which is attached to you personally.
Yes.
So that number from your Schedule C, regardless to if it's positive or negative, if it's negative, you're not paying any taxes because you can't pay any taxes on what you don't have. Exactly. However, you're not paying into your Social Security or Medicare either, right? Because it's not there. Now, if you have a balance there, you are paying into your Social Security and your Medicare, which is good, and you have to keep that up. But a lot of people are unaware of that. They don't see that, and so they get hit mainly with them self-employment taxes versus had they petitioned out to file out on Form 1120S, they would bypass all that self-employment tax and still be able to have the Roth or the traditional under the LLC.
Yep.
You get that? Entrepreneurs out there that's LLCs, we're helping you today.
Yep. I bet you a lot of people didn't know that. And then also just by establishing these accounts, outside of the Roth and traditionals, this is just another way to help maximize your retirement. So you can legally have more than one retirement account in place and max out on both. Okay, this is going to help you have more money at the end. All right, so I think we pretty much covered everything on IRAs. So, all right, so next I'm going to cover this chart known as the Ibbotson SBBI chart. So don't worry, it's nothing complicated.
What did you say the chart was?
Ibbotson SBBI chart.
Impotent?
Ibbotson.
Okay.
Right. And I forgot who that person was. I researched it a long time ago. So I can't bring it up right now, though. But yeah, it's a reason why it's called that.
I'm sure.
But SBBI stands for stocks, bonds, bills, which are treasury bills, and inflation. So the chart that you're looking at just simply shows the growth of $1 over a 99-year time frame. So if you look at the squiggly lines, that's exactly how the market works, okay? So you're looking at since the beginning of 1926 all the way to the end of 24. Now, even though you got all these ups and downs, you notice that the market is getting stronger, it's getting more expensive, it's getting higher and higher, okay? That is exactly why I am not worried about when the market drops. Because I know as I invest my money over the long periods of time, I'm going to end up winning. So the market could do negative 50% this year. I won't care at all. That doesn't mean that the share price is on sale for half the amount. And I'm going to be buying up everything. So go ahead, let it drop. I don't care. But anyway, so if you look under compound annual returns, you can see where it says small stocks. That's how much they've averaged over that time, 11.8%. Then taking a little bit less risk, you get large cap stocks, 10.4%, government bonds, 5%, treasury bills, 3.3%. So if you go back to the rule of 72 concept that I was going over earlier, This is where I got that 3% from. Okay, so I'm not just making up numbers. And then inflation historically has averaged 2.9. All right. Question?
Yes.
What?
Inflation at 2.9. Is that average per year?
No.
Is that the median per year, or does it fluctuate by the year?
No, it definitely fluctuates. But that's just what is averaged historically since the beginning of 1926 all the way to the end of 24.
Okay.
Yeah.
Wow.
Yep. So what you're looking at, this is not representing a specific stock. It's not representing a specific bond. It's not representing a specific mutual fund. Okay. So this is taking into account every single asset class that is out there in the world. Okay. And it's a lot of them. I can't even cover all of them. So it's actually a lot of data that goes into this chart, but that's divided up within its respective categories. Okay. All right. So that's pretty much it for that. Yeah, that's Will Smith showing us the way.
So wait, I do got a question. You said that if the market dropped, you would not care because you would still win. Are you still going back to the 72 rule because you've put the money in there, and even with the years you factored in the losses, you're still going to win? Or is it another math that you're doing that you're saying, okay, I'm investing now, and even if the market crashes, like I'm still going to win? Suppose we had a market crash like we did back in 2008 when Enron went down. Am I still going to win because that's money that's gone?
Yeah. So I'm not emotionally attached to the market at all. I don't make decisions based off emotion. I make decisions based off of logic. So I understand that the market has its ups and downs, but I also understand that you'll be able to win at the end of the day when you spend long periods of time in the market versus trying to time it. So most people that really don't understand a concept known as DCA, dollar cost averaging, which I'll get into later, they fear when the market drops, and then they end up becoming a sellout, meaning they end up selling out all of their shares. They pull out of the market, and then they try to get back in the market when it's high again. So they end up buying high, and they end up selling low. Mathematically, that doesn't make any sense to me. If you had merchandise and you was doing that, you wouldn't sell low and then start buying high, would you?
No.
Not at all. So why do people do it with their money all the time?
Because you need it right then and there.
Well, when we're talking about long-term money, you don't need that money right now. You don't need it tomorrow. You don't need it next week. You don't need it next month. You don't even need it next year. You're not retiring until at least like 10 years plus. So that's why I don't care what the market does right now. I'm going to keep investing. I'm going to buy a lot more shares when the market is low. And I'm going to keep investing even when the market goes back up, because this is going to skyrocket my market value. Again, I'm not emotionally attached to the market at all.
Would you be locked into the same rate by you doing that?
So the rate is definitely going to fluctuate. There's no doubt about that. What you're looking at is the average that is doing over a certain number of years.
Okay.
That's what I'm looking at. All right. So I was mentioning small and large caps. Okay, so I'm going to define exactly what I mean by that. And this is stocks that I'm talking about. So when I say small cap, mid cap, large cap, that's short for market capitalization of a company. Another way to look at that is what the company is valued at. Okay, so I'm going to walk you through on how we value companies, publicly traded companies. Okay. So small cap companies have a market capitalization of anywhere between $300 million and $2 billion. Mid caps are valued between 2 and 10 billion. Large caps are valued between 10 and 200 billion. Now, if you look at the lines in the middle, those just represents different indices that those type of companies will trade on. So the most popular one, I'm pretty sure everyone has heard of, is the S&P 500. Okay. For those of you all that are unfamiliar with the S&P 500 is, that stands for Standard & Poor's, okay, 500, which represents the 500 largest companies in the United States in terms of market cap, okay? That's what that is. So the line in the middle, that's the Dow Jones Industrial Average, which comprises of 30 companies exactly. And then you have the NASDAQ 100. So the NASDAQ 100 represents 100 companies in the United States as well, and this is mostly in the tech industry. Okay, all of these companies are in the non-financial sector. Okay, so no financial companies are in the Nasdaq, and it makes up about I say about 62% of tech companies. Okay, so that's what the Nasdaq 100 is. And then the line at the very top, this represents the average rate of returns of those type of companies. So you may notice that small cap companies has a higher rate of return in comparison to your large caps, even though their market cap is a lot lower. But the reason for that is because the market swings when you're dealing with smaller cap companies, you're taking higher risk and investing into them. And they also have more room for growth. I'm not saying that your large caps don't, but again, the market swings in your small cap companies is more volatile dealing with those. So also to attract me as an investor, you got to offer me a higher rate of return too. Your large cap companies are more stable in the market. Okay, they still go through ups and downs, but they're just more fundamentally set in place. So they're not affected as much by the market swings. So they offer a little bit lower rate of return. Okay, you're not taking as much risk with those. Now I'm going to go over a couple of examples. So this is going to show you how to determine the market capitalization of a company. You need to know two different variables. So let's look at small caps, for example. So PFS Investments Inc., that's actually my broker dealer. So on April 1st, 2010, that's when this company went through their IPO. That's initial public offering. They started off at $15 per share. The other variable that you need to know is the number of outstanding shares that company has. So 75 million outstanding shares got into the IPO on that specific day. So when you multiply those two numbers out, that gives them a market cap of $1.1 billion. So they open up as a small cap company, right? Now, example of a mid cap company, Morningstar. This is actually a website that I use a lot, pretty much every day, to research different types of mutual funds. Morningstar is an asset manager. So at the close of the market on November 7th, which was yesterday, the share price closed at $215.49. And they currently have a little bit over 41 million outstanding shares. So again, you multiply those two numbers out, and that gives them a market cap or a value of $8.8 billion. So they're considered a mid-cap company. And then an example of a large cap company, Automatic Data Processing, otherwise known as ADP. This is a company that I specifically use to implement 401ks. On the same date, November 7th, their share price closed at $254.16. The number of outstanding shares, they got over 400 million outstanding shares. So when you multiply that out, they're a $102 billion company. So that puts them in a large cap category, okay? Now, if I was to go outside of the scale, so going under small cap, you have micro cap companies. Those are valued between 50 million and 300 billion. I'm sorry, $300 million, right? Not billion, 300 million. And then right under nano caps, right under micro caps, you have nano caps, which are companies that are valued at less than 50 million. Now, if you ever heard of the term penny stocks, those are by definition publicly traded companies where their share price traded for less than $5. Okay, it used to be $1 some years ago. I can't remember what year they admitted that, but it's $5. Okay, so that's all that is. Those are more riskier, more volatile versus your small caps versus your mids versus your large. Okay. Now, if I was to go above large caps, that's when we start getting into our mega caps. All right. So now we're talking about going into the trillions of dollars in terms of market cap. So those are companies that are valued over $200 billion. So an example of that would be NVIDIA. NVIDIA actually ranks number one in the world. They have a market cap of $4.5 trillion. And they was actually the first company in the world to cross over the $5 trillion threshold. They did that earlier this week. Okay, so if you pay attention to the stock market, just go on like Market Watch. Just be nosy, find out what's going on in the world. You would have seen that. Okay, so that's pretty much it for capitalization. Okay, and again, if anyone has any questions, just drop a question in the comments. So now I'm going to go over the difference between growth and value stocks. Now I'm not going to read everything verbatim, but I'm gonna summarize it. A growth stock is basically a company where their stock is anticipated to grow at a significantly higher rate that's above like the average growth of the market. Okay, so these type of companies generally set a trend in the market. So example of this will be Apple. Apple will be considered a growth stock. Growth stock companies generally do not pay dividends. If they do, it's like really, really low, and it's not that often. Okay. What their goal is to do is to take all of their profits, reinvest it back into the company to further grow the company. So one of the three ways that you make money off of in a mutual fund is off of a process called capital gains. Growth stocks generate capital gains. So that's when you buy a stock for one at a price, and then later on in the future you sell it for a higher price. And depending on how many shares you sell it for, and the difference between when you what you bought it for and what it's currently selling for, that would determine its capital gain. Okay.
Explain that again. You lost me.
Okay.
Do that again.
So you buy a stock at one price, and then later on you sell it in the future for a higher price, and that'll generate a capital gain.
Right.
That's basically what it is.
Okay. So it's my money because I got money on top of it.
Well,
I gained money off the sale.
Yes, and that's when it becomes a realized gain, or it could be a realized loss.
If it didn't make no money, of course.
Exactly. Yep. So it's unrealized when you don't touch it and you just let it do its thing, and it becomes realized once you sell it. Okay. And then you got value stocks. Value stocks are dividend paying companies. Okay. So a value stock is basically where the share price appears to be trading at a much lower price according to that company's fundamentals. So value investors generally understand the financials of a company. So I'll give you a perfect example, Walmart. So on the date, March 16th, 2020, the share price closed at 106.76. Value investors are looking at that 106 saying, okay, that's pretty low, but I believe it's going to increase significantly in the near future. So I'm going to buy in at this price with the expectation of it going up pretty soon, which is exactly what it did on September 16th, 2021, which is 18 months later when the price went up to 105.03. That's a 35% increase in 1.5 years. That right there will be a value play. Okay.
This is gambling because what if it didn't increase?
That's just how the market works. But again, you're playing a long-term game. This is a short-term.
Okay. So now, even if it didn't win, I'm still okay because it's long-term.
Exactly.
Okay. Better than short-term. Got it.
Yep. Yeah, so this is different than trading. Trading is a whole different aspect. We're talking about investing.
Yes.
Okay. Investing is always long-term. Trading is always short-term. Okay. So generally, dividends will pay out quarterly. But depending on the company, it can pay out monthly, quarterly, semi-annually, or annually. However, when you sit down with me and I diversify your mutual fund, meaning you're investing into several mutual funds, you will start to generate a mix of your small caps, your mid caps, your large caps, your mega caps, even micro caps. And then also they'll be divided into your growth stocks, your value stocks, or even a blend of both, so you're getting the best of both worlds. So you're always going to get your dividends. I know when I look at my statements, I get my dividends pretty much every month, okay, because of how I have it diversified. All right. Any other questions on that?
No, I'm great. I'm great. I can't wait to invest.
All right. So this is going to help individuals to understand their level of risk. Okay. So this is known as the risk chart of mutual funds. So I'm going to start off at the top right, which represents the highest level of risk. And then I'm going to work my way down to the left, which represents a more conservative risk. Okay. So I'm not sure if anyone out there is familiar with what's known as the emerging markets. In that category, you have what's known as BRIC nations, and that's an acronym. So that's Brazil, Russia, India, China, and South Africa. So the BRIC nations were formed back in 2009 with the addition of South Africa in 2010. Included in that list, they also have, so these are like the founding fathers, okay? So also on that list, they have, I'm trying to remember all of them, they have Iran, Saudi Arabia, UAE, which is United Arab Emirates, Ethiopia, Egypt, and they also have the addition of Indonesia. Indonesia is the newest one established. I think they joined like in February of this year. But they also got a whole bunch more applications on the list for more countries to join. So financial experts basically say that by the year 2050, these 5 countries will be dominating the entire global economy. The whole goal of BRICS is to create their own currency and to move away from the dependency of the U.S. dollar. And I say that because a lot of countries, they buy our U.S. government bonds, okay? They want to move away from that. So that's their whole goal. Now, as we take a little bit less risk, we get into the international market. Now, the international market contains the emerging markets with the addition of the more developed companies and the more developed countries, okay? So you could pretty much find, like all of these products throughout the U.S. or North America, whatever, they're just based overseas, okay? That's the only difference. So a couple of examples would be Honda, okay? Everyone knows who Honda is. They're based in Japan. Nestle, they're based in Switzerland. Samsung, I use a Samsung Galaxy phone now, based in South Korea. Louis Vuitton, that's a French-based company, okay? Saudi Aramco, they're an oil-producing company in Saudi Arabia, all right? And then we're going to get into our U.S. small cap stocks, so we're taking a little bit less risk now. So if you just look over to the left, a couple examples: Vizio, Fila, Fannie Mae, Frontier Airlines, Aston Martin, okay? Remember, those are companies that are valued between $300 million and $2 billion. Then we get into our mid caps: PFS Investments, Valvoline, Mazda, Planet Fitness, ADT. Then we get into our large caps, a little bit less risk: Shell, Pepsi, AT&T, Verizon, Uber. Okay, everybody knows all of those companies. Now, and then of course you got your mega caps too. And then we get into balanced mutual funds. So balanced funds will contain stocks and bonds. Now, here's the difference between a stock and a bond. Stocks is where you're buying ownership into a company. Okay, so you own a percentage of ownership into a specific company. Bonds is where you're lending money out to different types of entities. Okay, so before I get into the bonds, I want you to look over to the right side. So you see 5 different categories, and that represents different portfolio models. So according to your level of risk, how much risk you're willing to take in the market, those that are considered aggressive growth are invested 100% in stocks. So your portfolio design will contain mega caps, large caps, mid, small, micro caps, international funds, and also emerging market funds, okay? 100% stocks, no bonds. Those that are considered growth, you're about 85% stock, 15% bonds, okay? So the more bonds you add into the mix, that lessens the volatility of your portfolio, or another word for that, it lessens the risk, okay? Moderate growth is 65-35, conservative is 50-50, and then income will be 30% stock and 70% bonds, okay? So that's how that works. And then getting into our bonds, so we have 3 different levels. So you got corporate bonds, municipal bonds, and then you have government bonds. Corporate bonds represents the highest level of risk, okay? So your corporations will go bankrupt before the municipalities will. So municipalities will represent like the state or the city level. The states will go bankrupt before the U.S. government goes bankrupt. And if the U.S. government goes bankrupt, then you ain't going to care about your money. I guarantee you're going to be worried about a whole bunch of other stuff.
But your money is going to be gone at that point because it's bankrupt, correct?
If the government goes bankrupt, probably. Possibly.
And I let my money sit there and it's gone.
But how often has the government gone bankrupt, though? I'm not saying it can't happen. I mean, it can, but it's like very little chance of that happening. Very little chance of that happening.
I don't know. It's kind of risky. You got to be willing to take the risk for this, though.
So, as I mentioned before, corporate bonds are more riskier,
right,
than municipals. Municipals are more riskier than the government bonds. In general, government bonds are relatively safe.
So, when choosing, what should you choose? Government bonds?
So, I have in my portfolio models, I have different mutual funds that are designed to fit your suitability.
So, it's based off the individual person?
Absolutely.
Touche. Understood.
Absolutely. But you'll have a mix of those, though. But again, it's depending on your risk. I'll have more of it weighed on, let's just say, government bonds versus corporates. Okay? So I'll determine that for you. That's nothing that you have to decide. as an investor.
Oh, I just got to give you the money.
So I gotta know you as an individual.
True.
And get to know your risk tolerance. Once I have all the information that I need, then I'll be able to make the appropriate suitability recommendations for you.
Okay, so it's not like I could come to you and say, "Here's 10,000. I want to invest in Wrigley's spearmint gum." That's not how they go.
No.
Okay.
No.
Got it.
Not at all. All right. So that's it for the bonds. And then taking a little bit less risk, we start getting into banks, credit unions, life insurance companies, again, which I'll talk about life insurance on another day. And then you got a category called UIMs, which is simply stand for underneath your mattress.
That's money.
Yeah, but it's under your mattress. UIM.
Yeah, it ain't in the bank. So it's not receiving compound interest.
Not at all.
But you're not losing it either because it's not nowhere where something can go wrong.
But consider inflation too. You're losing buying power.
But I got all that money right there.
But there's still inflation. The value of money is cut in half every 15 years. So if you look at the quality of living 15 years ago, things were a lot cheaper then, right?
Absolutely.
Your mortgage, rent, groceries, gas.
Absolutely.
Go back another 15 years, so 30 years ago. Gas was like $1 there. Or less than that. Them prices ain't coming back.
Yep.
So you are still actually taking the risk by not investing your money.
So it's like a catch-22.
Not really, but you understand the logic behind it.
And the main logic is don't use emotions.
Exactly.
Clearly, my emotions is in this.
Understood.
This is my money. I work hard for. Like think about it. You got somebody that didn't work. They didn't put all of this money into this, and now it's gone. If the market crashes, but you, on the other hand, are saying it's not going to happen to your money. Your money is safe.
No, I'm not saying that. I'm not guaranteeing that. I can't guarantee that. What I'm saying is that I'm just not emotionally attached to my money because I understand how the market works. So again, I'm using my logic versus my heart. I mean, I'm a licensed professional. I teach this stuff, so that's expected coming from me. But from the investor standpoint, I definitely understand that, which is why I'm here as an advisor to you.
Got it.
To help you walk you through that process and to help you, process those emotions because I get it.
That's a lot of money, though. That's a lot of money. If we got any questions, comments, please feel free to drop them in the comments. Give us a phone call. I know somebody out there is concerned about their 401k, their IRA, mutual funds. Like, whoa. I kind of want to invest, but I just want to see my money grow. Like, boom, right there. And I got it. And I know it's not going to happen like that. That's just in my mind. Nope. I get it. But I want it to go boom and nothing happened to it.
Well, what did I say? This isn't an overnight thing.
Apparently.
Yeah. Yeah, if you're looking for an overnight thing, then get into a pyramid scheme.
So wait. Okay, I'm glad you brought that up.
Okay.
Let's talk about that.
Okay.
Then I'm going to be devil's advocate.
Okay.
Okay, so pyramid scheme.
Okay.
How do I know you're not taking my money and putting it into a pyramid scheme?
Okay, so number one, I am properly licensed. So
was the other people.
So you got the Bernie Madoffs. The FBI has my fingerprints. Okay, they know everything about me. I don't work too hard for my licenses and to get to the point where I'm at. So I'm not running away with nobody's money at all. Okay, I ain't going nowhere with your money. You either trust me or you don't.
That's a lot of money I'm putting in. Like just think about it. I come to you with all of my retirement. I didn't gave you $100,000
right
to invest.
Okay.
Now you send me monthly statements every month.
Quarterly.
Oh, quarterly. Okay, fine. I'm able to have a profile where I can log in and look at my account daily if I chose to.
Yep, it's available 24/7.
So I see the numbers increasing
as time goes forward,
which is a good thing.
Mm-hmm.
Now I need my money and I can't get it. What happened to it?
Why can't you get to your money? That's the question.
It's not there. It's gone. Some of the pyramid scheme.
Mm-hmm.
So you see where I'm going with this. Like, I'm entrusting you with all this money. Right. I see everything online. Mm-hmm. I get a quarterly statement, but yet when it's time for me to come get my money, it's no longer there.
So that means you're dealing with the wrong person. That's not going to happen with me. That's not going to happen with me.
Okay.
Again, you can look me up on brokercheck.finra.org. Type in 614-7994. That's my security CRD number, and you'll see that it's me.
And that's why I like working with you, because I could research you. I could see this, and you're so dedicated that you stand on it. That look, I'm not here to steal from you. I want to help you grow. Mm-hmm. So when people come give you their hard-earned savings, they don't have to look at it as a pyramid scheme, or you're going to take their money and invest it into what you want to invest it versus what's going to help them grow financially.
Exactly.
I'm with it. I got my $25. Now, I don't know if I got the other 65 years, but I got my $25.
All right. So I want to go over the process of how bonds work. So I'm going to give you an example. So let's say we got take Apple, for example. Say Apple wants to build 1,000 new stores worldwide, and it's going to cost them, hundreds of billions of dollars to do so. Apple is currently at least a $4 trillion company right now. They can easily write a check if they wanted to, but they're not going to do that. They don't want to. So instead, they go through a process called OPM. You ever heard of other people's money? So they do that by issuing out corporate bonds to the public. So let's say us as the public, we invest into these bonds. Let's just say it's $1,000 bond, okay? So we buy the $1,000 bonds, we invest into it, and that's how they raise the capital. So out of the capital, they build out all the new stores. And once they got all the new stores built out, they start to generate a profit. Now from the profits, they open up a new account. Out of that new account, that's what they use to pay back all of the bondholders, okay? So you got people like Ice Cube looking all disgusted and busted, wondering when the heck he's going to get his money back, okay? That depends on the bond's maturity dates. So that means that's when you're going to get your initial investment back. Now, as you're waiting on that maturity date, bonds will always pay you semi-annual interest. So you're going to get paid interest twice a year, and then on that maturity dates, that's when you're going to get your $1,000 back, okay, in my example. So that's how that works. Now, Shavonda, just like you and I, we have credit scores, right?
Mm-hmm.
Bonds have bond ratings. So from the highest rating, meaning the safest, you have ratings of AAA, AA, A, and then BBB. In that category, that's considered investment grade bonds, meaning you're very safe. You're at low risk of default. Now, anything that's rated as a BB or a B, those are more riskier investments. And then anything that's rated under a B rating is considered a high yield bond, or another word for that is a junk bond, okay? So the reason why it's a high yield bond is because you're taking more risk by lending your money out to that type of entity versus a higher rated one. So you can have a AAA rated company and they can offer you a 4% rate of return, okay? Very safe. Versus a B rated company, you're taking more risk with that, so you're going to have to offer me a higher rate of return. Let's just say 3 points higher, so 7%. So just like how the stocks work, the more risk you take with them, the higher the reward potentially. The lower the risk you're taking, the lower the reward, okay? Bonds are just more conservative in the market in general. Stocks are more aggressive. All right, you got any questions on that?
What's going to last longer?
What do you mean?
Between bonds and stocks, what's going to last longer? So with the bonds, you're going to get paid interest semi-annually.
Yes.
You didn't say that with the stock. That's not going to get paid semi-annually.
Stocks don't pay interest.
So it's best for an individual to do bonds if they're looking for interest to be paid.
If they are more conservative investor.
Okay. But no matter what the entrance is, they're not going to get more than what they put in on that maturity date, period. So they can your example was $1,000.
Okay.
And on the maturity date, they get the $1,000 back.
Right. Plus all of the interest that they've been paid throughout that investment period.
Right. Versus if it was just a stock, it's no entrance at all. It's just sitting there growing.
Right. You only get paid capital gains from when you sell the stock.
And
if it's a growth stock,
and
then you get paid dividends if it's a value stock.
I think I want to go with bonds because at least I'm getting something semi-annually.
Well, remember, we're dealing with mutual funds, so you're dealing with a diverse mix of everything.
So I have an option to have all of this.
Yes. Yeah. So in your portfolio, your investment will be growing with interest that's being paid through the bonds. It's still going to be growing with the capital gains from all of your growth stocks that are in your portfolio. And you're also going to be getting paid dividends from all of the value stocks that are in your portfolio.
Because you created this based off the diversity, the classification, and you know who I am.
Yeah.
High five. I was listening. Woo-hoo!
So remember, I said that mutual funds, they own anywhere between like 50 to 200 companies,
right,
on average. So let's think about how diversified one mutual fund is in itself. So the more money that you're able to invest, the more mutual funds I can add in to create a portfolio, which just further diversifies your portfolio.
Right, of course. So that makes sense. The more money you put, the more companies you could put in.
So I'll give you an example. I can create an aggressive growth portfolio where you'll be invested into a little bit over 1,000 companies if you're able to invest $500 or more per month.
Per month?
Yeah. If you're investing $500 per month.
Oh, that's not per year?
No.
You did say aggressive. I missed that word. Okay, but that's understood. So I'm paying $500 a month, but my money is growing. And it's not just stuck in the actual stocks. I got stocks and bonds.
If you're aggressive, then you have 0 bonds in it. If you're growth, you have about 15% bonds in there.
That's still not bad. 15% is still not bad. Because that's a starting point.
Yeah. But again, it's according to your level of risk that you're willing to take.
Bingo. And with me, since I'm still using emotion, we're going to stick with that 15%.
That's fine.
Okay. Can we go lower?
Yeah, I mean, if you want to go moderate and you want to be 65-35, that's fine. Okay.
Not a problem. Got that. Understood. I like this. Oh, I should have paid attention in school. No, but this class was not that interesting in school. And the teacher was so boring.
Yeah, that's how it normally is when you work with numbers. Okay, so this is dollar cost averaging. I had mentioned this earlier, so I'm just going to go more in depth with this. How much time do we have left?
We got time. Our show ends at 5:15.
Okay, I can finish it then.
Oh, we're gonna finish.
Yeah, and still have our room for Q&A. So
yes.
Okay, so what I'm getting ready to show you, this simply shows the battle between logic and emotion. So this is really going to hit hard on that. Okay. So you have an example of 2 investors. They're both investing $100 every single month for a period of 6 months. Okay. This is just an illustration of how this concept works now. Okay. Now look at investor A. $100. The share price is $10. So they just bought 10 shares for the first month. Okay. Easy math. Now, if you go forward, every single month that goes by, the share price is increasing. So they're getting more expensive. They're investing in a steady rising market. Okay. Now you notice that the number of shares that they're buying for that same $100 is actually decreasing. Again, because the share price is getting more expensive. Okay. So you're buying less for the same dollars. Now, when you add everything up, total number of shares that investor A owns at the end of 6 months is a little bit over 42 shares at an average cost per share of $14.19. Now, to determine what your market value is, you got to take the current share price, which is $20 in their example, multiply by the number of shares that you own, which is 42.28. So that gives investor A a market value of $845.60. So they put in $600 altogether, which means they're at a profit of $245. Okay.
In 6 months.
Yes, in 6 months.
Okay.
Now, investor B, they're doing the same exact thing. They're just in a fluctuating market. So we're gonna look at month one again. $10 per share, $100. They just bought 10 shares. Okay, same thing as investor A. Now in months 2, 3, and 4, you see that the share price is going down. Okay, so we're in a negative period. As the share price decreases, the number of shares that you're buying is increasing. So it's at a discount. Okay, the market is on sale right now. That's how you want to look at that. And then in months 5 and 6, the market recovers back to the same $10 where they started off at. Okay, so their shares are worth $10 per share, not 20. The total number of shares that they now own, I'm gonna just round that up to about 126. Okay, at a much lower average cost per share of $4.76. So how do we determine our market value? Multiply the number of shares that you own times the current share price. So that'll be 10 times 125.96. So investor B actually has a market value of $1,259.60. Now you probably would have thought that they would have had less because the market dipped.
Right.
But because they stayed invested, they bought a whole bunch of shares at a discount. So when the market went back up, that multiplied their market value. So the name of the game is how many shares do I own? You want to own the most shares at the end of the day, okay?
Wow.
Now, again, this is long-term investing. You don't want to care about what the market is doing, okay? You don't need your retirement money right now. You don't need it tomorrow. You don't need it next month. You don't need it next year, okay? This is like 10 plus years or more, okay? If you're in that category. So again, I don't care if the market did 50%. I'm gonna double, triple, and quadruple up on my investments. I'm gonna buy it all.
Okay, I'm gonna just throw it out there. You saving this money is for your retirement.
Mm-hmm.
Bam, the roof cave in. I ain't got no money, so I want to come here and get this money.
Nope, you're not gonna do that.
Why?
Because I already established an emergency fund for you, which is going to prevent you from dipping into your retirement. And you also got money stored up in your bank savings account that I mentioned earlier. That's what the emergency fund is for.
So I got all this money. So that leaves me no room to need to come here and take from this pile.
Exactly.
Because I can take from other piles.
Exactly.
Now, for investor B, for months 2, 3, 4, and 5,
mm-hmm.
it dipped.
Mm-hmm.
It went under.
Right.
Am I going to get a notification that the shares are low so I can purchase more to stay above investor A? Because again, I want my market value to be worth something in the end.
So no, you're not going to get a notification that the market goes down because it's constantly fluctuating. Okay. This is something that you all want to pay attention to, like on a regular basis. Plus, you also have me. Okay. Now, I'm not going to call every investor every single month saying that the market is doing this, is doing. No, I'll stay in contact with you, like so many times per year, just to make sure you're okay with everything. Do you got any new money that you want to invest? You got any referrals? Are you okay with your overall investment? I'm gonna steady check in with you, but yeah, you're not gonna get a notification every time the market dips.
So let's just say for month 4,
okay,
the share price went down to $2.
Okay.
And at the $2 price, you purchased 50 shares.
Right.
Are you going to automatically know that's how many shares that I want to purchase at $2? Or would you go in and say, hey, we'll do 100? Like, how did you come up with that number 50?
So
is it all mathematics? Is it a phone conversation? What happens to determine when the market does get a cut like that for $2 a share?
Okay. So the answer is no, because your investments are all automatic investments.
Got it.
Everything is automated. So you're not doing anything manual here. You can go into your account and make manual trades, anytime you please. But let's just say you set on the 15th of every month that $500 is going to come out of your checking account to purchase shares of XYZ mutual fund. That's what's going to happen every 15th of the month. So you don't even have to think about it. The key is to staying consistent over a long period of time.
Yeah.
That's the key right there. So for individuals that really don't understand this concept, you know, and you have that fear of the market going down, most people are feeling like this dude right here, sweating bullets, worried about their money, you know.
Yeah, because I'm shaking and I ain't even gave you $1. So, and I'm over here shaking. But I like Investor B. It seems like Investor B come out more profitable than Investor A. But then again, the share prices went up.
It recovered eventually.
Absolutely.
So I'll give you an example. So we all remember what happened back in 2008, right?
Absolutely. Enron.
Everybody lost money. Even if you was invested in bonds, everybody lost money. I don't care what asset class you was invested in. Everybody lost money. Well, I'll reword that. Everybody's market value went down. You lost money if you decided to sell your shares, in which it became a realized loss. Again, that's the only time you lose. However, for those smart enough and that understood this, stayed invested during that negative period, understood that they're buying more shares at a discount. Because that's all it is. When the market is negative, the share price is on sale. So that's your opportunity to buy more, not to get out. So again, you just stay invested, you stay consistent, let the market do what it's going to do. We have no control over it, okay? We have zero control over that. But again, what I do understand from history average is that the market is going to be down 1 quarter at a time. That's it. So it's going to be up 3 quarters at a time. So time is on your side.
And so that you need, what you're basically saying is, since time is on our side, when the market drops is when you need to be more invested in it before it recovers to the higher amount.
Pretty much, yeah. You want to take the opportunity to buy more. So think about when you're in a retail store, and you know they always got like these sales that's going on. That's going to attract you to buy that specific product or buy more of it, right?
Absolutely.
Same thing here. Buy more shares when it's down. Same concept. It's going to go back up. We don't know when, but it's going to go back up at some point.
Because we know it stays up 3 to 1, because that's the ratio. It's up 3 months. I mean, it's up
3 quarters.
3 quarters and down 1 quarter.
Exactly.
So 3 months out the year, we know that it's going to go down.
Well, I'm talking about yearly. So 1 out of 4 years would be in the negative market.
That's still not bad, because you're still up 3 years.
Yeah. Yeah.
Oh, that's a nice analogy.
Yeah.
Okay.
So for those that just, ride out the market and is not worried about it, they can just enjoy themselves. Yeah, I look at, my accounts on a regular basis, but I don't have that fear of it going down.
Yeah, but that's because you do this.
Right.
And you don't have emotions tied to it.
Exactly. Right.
Again, anybody got any questions, please feel free to drop them in the comments. Also, our phone lines are open at 312-837-7219. We are talking about investing, making your money basically work for you, in a sense.
All right, so I'm going to wrap it up with this last part. So I have a question that is not meant for you to answer out loud. I forgot what kind of question that's called. Rhetorical question. So how do you turn 210,000 into 2.8 million? All right, so just kind of think about that for a second. How do I turn 210 and flip it into 2.8 million?
Put my ski mask on.
No, we're not out here talking about robbing banks.
Didn't say it was a bank. I just said I was putting it
on. So this is a hypothetical that I drew up. So let's say you invested for retirement for 35 years. You start at age 30 all the way to 65, okay? So the dates that I'm using is March 17th, 1988 for 35 years straight, okay? So 2023. Shavonna, can you agree that we had quite a few negative periods in the market between 88 and 23?
Absolutely.
Okay.
Most definitely.
All right. So we are using a large cap value mutual fund, okay? So remember, large caps are companies that are valued between $10 and $200 billion. Value stocks, those are your dividend paying companies, all right? So We know exactly what we're using. The portfolio model that we're using is growth. So we're looking at 85% stocks, 15% bonds. We're investing into a Roth IRA, 100% tax free. So even in retirement, you don't have to worry about paying taxes because we're in the Roth. You're investing $500 a month. So if you do the math, that's $6,000 per year. $6,000 per year times 35 years. That'll give you the 210. Okay, so that is your principal or your contributions that you've invested over that 35-year range. I deal with Class A shares, so those have an upfront sales charge. So the charges that you would have paid over the 35 years is $6,500. And then I kind of drew out a range. So I did like the best share that it performed along with the percentage, and the worst share that it performed along with the percentage. So its best share performed in 91, where it did 66.7% rate of return. Worst share 2008. Again, remember what happened that year. Negative 34.7%. Okay, so it lost 34% of its market value. But throughout all of those positive and negative years, it experienced 28 positive years, and it went through 7 negative years, all averaging at a rate of 9.22%.
Okay, question. Mm-hmm. Can we take the same math and do from ages 50 to 75? Because you started at age 35. Mm-hmm. So we're just going to assume, for the sake of the time frame that we're in, mm-hmm, let's just say we got some 40-year-olds on here. They're not 35. Is it too late? 50-year-olds, is it too late? Because you went over a 35-year time span.
True.
So in order to get this 210, do we still have to invest aggressively to catch up? Or is there another way that we can still hit that within a shorter time frame?
So if you are later investing, yes, you do want to be more aggressive to kind of catch up. And then additionally, if the job isn't enough for you, become an entrepreneur, open up that LLC or that S Corp so you can open up a business retirement plan. That way that will help to maximize your retirement. So you have more money that's being invested in retirement. That's how you do that. I know easier said than done though, but that's the process.
It is the process. It's no more putting it under your mattress.
Exactly.
Or in the cookie jar.
And to be honest, the job just simply ain't getting the job done. Okay.
No, even with the matches that they're matching, because to see a percentage, you would have to max out at about 15 to 20% if the company is matching that.
Yeah, if they are. So, and that doesn't matter to me too. So, we got all of these different retirement vehicles that are out there, and you may be wondering which is the best one for me to do, or if there's like an order of operations in terms of retirement. So this is the order that you want to do it in. So coming from an employee perspective, generally, you work with a corporation, they offer a 401k. Or if you work like for a church or in a school system or a hospital system, they'll offer you a 403b. And you've probably heard of TSAs, tax sheltered annuities. Those fall under the 403b provisions. Or if you're a federal employee, such as a postal worker or an FBI agent, they offer you the 457b deferred comp, okay? Better known as TSPs, thrift saving plans, okay? So it really just depends on the entity you work in. But anyway, so you work with those different types of entities, and if the company offers you a match, invest all the way up to the match. Okay, it's free money. Take advantage of that. After you maxed out to the match, you want to open up a Roth IRA and max that out at $7,000 or $8,000 per year. Once you max that out, come back to your 401k or 403b, whatever, and max that one out at $23,500 per year, or I think it's $31,000 per year if you're 50 to 59. Now, if you're 60, 61, 62, or 63, then you can max out.
It's $7,500.
I don't think it's that much more. I don't know. It might be.
It's $7,500.
Okay.
Yeah. And going back, piggybacking off what you just said,
Mhm.
opening up that contributing to the IRA,
Mhm.
that's a tax deduction.
If it's a if it's a deductible traditional IRA.
Yes.
Only.
Yes, but they have to know that.
Yeah.
And a lot of times companies aren't giving out this information.
Right.
So they're going to get that information when they come sit down with someone like you or myself, because that's going to be the first question.
Yes.
Is this tax deductible?
Right. In a deductible traditional IRA only.
Yes.
Now, some people may have heard of a backdoor Roth IRA. So this is how that process works. So these are for like higher earning individuals that don't qualify for a Roth IRA. So you will have to contribute to a traditional IRA. That traditional IRA has to be a non-deductible traditional. So you invest up to the max, you max that out, and then you are backdoored by converting it into a Roth IRA. So that's how you can do that. Again, it has to be a non-deductible though, because the IRS, they're not going to let you invest into a traditional deductible.
No, they're not.
And then backdoor it and try to get into a tax-free. No.
Yeah, no, because they losing money like that.
Exactly.
No, why would they lose money? That don't make sense.
Exactly.
No, I get it. So yeah. Wow, that's interesting.
And I'm gonna be real. That's something I actually learned recently. I just learned about that this year. Never heard of a backdoor Roth IRA. So I'm like, okay, yeah, let me do my research on that. So I can better explain that to our viewers.
But so here's my question. Because the non-deductible is tax related, of course, tax laws change every year.
Of course.
And what we learn right now, 9 times out of 10 come January, that's going to be out the window. A percentage of it will be, of course.
Yeah.
So with the backdoor concept, would that still be available in the current years, or is that just now? Is it going to change? Do you see it changing?
I definitely see it changing because, as you mentioned, tax laws change all the time.
I'm sitting for my test tomorrow. Absolutely.
Okay. Yep. So that's just something that us as financial professionals, we have to keep up with. Yeah, so I don't know if it's going to be the same next year. I honestly don't know.
But for right now, if they still wanted to get into it and use the back door, they could now if they had the funds available.
Yeah.
Got it.
Yeah, they definitely
got it.
Yep.
That makes a lot of sense.
All right. All right, so getting back to our slide, your market value will go to about 1.4 million, okay? So that's during your accumulation phase. Now we're going to flip the script and we're going to go to our distribution phase. So now you're in retirement, okay? So I took that 1.4 million. Now we're withdrawing income for retirement, okay? Because it's needed. So let's just say you were retiring for 25 years, so from 65 to 90. This time we're using like one of those balance funds, so large cap and a corporate bond fund. You're taking less risk with this one, of course. So you downgraded from growth and you went to moderate growth. So now it's 65-35. You're taking out $75,000 each year, 100% tax free. Had this been a traditional IRA, depending on the individual's tax bracket, they could have expected to pay maybe about $15,000 a year in taxes. Okay, I can't really exact those numbers, but let's just say about $15,000 a year. So they'll be living off of $60,000 per year. But again, since they're investing into a Roth, they don't have to worry about taxes, so they can live off the whole $75,000 per year, and that's like $6,250 per month.
And that's at retirement.
In retirement.
And they still got the emergency funds and the bank account and everything else you mentioned prior to having this money.
Yeah, if they haven't touched it. Yeah.
So, whoa.
But that's because I set it up the correct way, though, and we've had those conversations in the beginning. So one thing I'm not going to do, I'm not going to open up a retirement plan for you and not have an emergency fund. That doesn't make any sense. That I'm not going to do. That's going to put you in a vulnerable position.
Right.
Because, life happens. You're going to need some money tomorrow because something's going to happen. But you got that emergency fund to pull from. I'm not going to allow you to pull from your retirement fund. That's doing a disservice to you.
That's excellent. So you're on top of it with your client.
Yep.
Because the ultimate goal is to retire and live comfortably.
Yep, exactly.
And
but not just comfortably, but to live off of your earnings where you don't have to worry about running out of money. That's financial independence. So the one number that you need to learn is your financial independence number. And that's the amount of money that you need invested where you can live off of that money without worrying about it ever running out. So retirement is not an age. It doesn't care about how young or how seasoned you are. It cares about how much money you got invested so you can live the lifestyle that you desire to live. That's what it cares about.
I'm going to need you to say that one more time for the people in the cheap seats. say that one more time. Wow.
Yeah, so again, and now I'll mention that again in a second. So I just want to finish this part up. So looking at the total amount invested, that's actually the 210. Those are your contributions. All it did was just move the 1.4 million, which is what it grew to, over into this fund. So if you do the math, the total amount of withdrawing, $75,000 every year for 25 years, is actually 1.8. So you might be thinking, okay, 1.8 million, that's more than what I have invested. So one thing that you got to keep in mind, this money is still working for you. The money is still invested. So it's growing at an average rate of 7% in this example, which is why the market value actually increased to 2.8 million, just to round it off. And so that's my celebrity wife right there. Maybe don't hate.
Wow. So wait, you mean to tell me my money could grow to $2.8 million?
It could. If you're hypothetically in this situation, then yeah. And that's based off of what the market actually did with these specific funds. I just can't get specific, on the live.
Got it. Understood. But it's close enough. This is an excellent visual.
Mm-hmm. So what you're literally doing, you're living off of all of the growth without touching your principal. So that 210 is still sitting there. You're living off of all of the capital gains, which comes from your growth stocks. You're living off of all of the dividends, which comes from your value stocks. You're living off of all of the interest, which comes from the mix of bonds. Okay? Again, that's just the growth.
So I'm getting 3 incomes.
Technically 2, because dividends and interest is a form of income when you look at your statements.
Yeah, of course, because you're gonna get a 1099 DIV and a 1099 INT. Absolutely.
Yeah. Mm-hmm.
So but I'm still getting money.
And then your capital gains are generated from where the investment advisors are selling off the stocks at a high.
That's Form 1099B.
Yeah.
So, I think I'm gonna like investing.
So that right there is the power of a mutual fund. So once you really understand that, then you can see how it can really benefit you. And so that's pretty much it. That's all I got for y'all.
Okay, so look, I've been asking all the questions, right? So that ain't fair. We're gonna open up the lines for somebody to drop in some comments. Also, people, please, thank you for tuning in. As always, please share the content. Again, you never know who needs this information. You never know who wants to invest. If you want to invest now, please do so. Mr. Owens, I'm going to ask that you be so gracious and give your contact information to all of our viewers and listeners, and tell us how to set up appointments with you. And you were just so remarkable. I just want to set up an appointment right now.
Yeah, so you can reach me at my cell phone, 708-670-0595. You can just text me your name, and I'm going to send out a Calendly link to you. That way we'll be able to book an appointment, and we'll conduct business that way. Again, it's 708-670-0595, or just reach out to me on my Facebook page. It's pretty simple.
And y'all know I've been tagging him for the past 2 weeks. Like I have gained so much insight on what you have talked about. What I am most interested in is all the different type of accounts that I could have. I'm gonna have an emergency fund account. I'm gonna have a mutual fund account. I'm gonna have a bonds account. So I'm getting money from every direction as long as I invest with using logic and not emotion.
Exactly.
But you work with people like that because you automatically know.
Yeah, I get it.
How one thinks.
Yeah, I get it.
He said, "I get it. I get it. I get it." Okay. So now, and again, people, I understand. If you're anything, and you think like I think, you always think outside the box. Like, what if this could happen? What if that happened? And I know we brought up Ponzi schemes, and again, scammers are out here. That's their job. They scam to scam because of the thrill. But what we're doing here is trying to help you retire early. We want you to understand the market. We want you to understand how to make your money work for you, and how to live comfortably. Like, I would love to live off $6,200 a month, knowing that all my bills will be paid and I still have extra money to live off of. So if you want more information, and I will be posting Mr. Owen's information. If you want more information, please reach out to Mr. Owens. It is so very important for us to just start. Like, we don't have to wait. We can start right now. There's no need in waiting. We done waited and procrastinated long enough, as he said, and he had a slide to show us that if we wait, we lose out on so much money. We lose out on so much money and time. It's no use of losing that. So contact him at 708-670-0595. Right?
Yes, ma'am.
Okay, I was right. So look, I'm so very eager. I'm so very excited. I would like to thank you for coming out here, sharing this information with us.
Thank you for that.
Thank you for talking to us. And guys, I know I done had a lot of phone calls. Like, a lot of people said they weren't going to be able to make the show. They didn't want to do a recap because they wanted to just be there live. Listen, we will be doing more shows about this, because it doesn't just stop here. It doesn't. And it's continuously growing. We want people to grow. We want people to, again, live comfortably and let your money work for you. And that's what we're here to do. So we're going to try to be doing these seminars every quarter. I'm going to also have Mr. Owens come back out here and talk about life insurance, because again, that's another area where we don't focus on a lot of attention on that area. We don't talk about that as much as we should.
Right. Definitely not. And one of the main things when it comes to life insurance is understanding your policy, which even a lot of agents that sell life insurance don't understand what they're selling themselves. And it's just an area in the financial sector that honestly pisses me off, because of some of the products that's being sold out there as investments, which is actually illegal. But again, we'll talk about that on that segment.
So yeah, we're going to be bringing you a lot of information here on Let's Talk Finance. Again, we are definitely about educating and empowering and improving our people. That's why, please share the content, people. Share the content. You never know who's going to need this information. But Mr. Owens, I, on behalf of Anointed Accounting, would like to thank you for coming out on a Saturday.
Appreciate it.
We just want to say thank you. We appreciate you. Please accept that token of appreciation from us. We love you. And like, we cannot wait to work with you. Please leave your contact information for our viewers again. He will be back, you all. Not next week, but he will be back. We will be collaborating and working together and doing some things together. So, Mr. Owens, please leave your information for our people one more time.
So again, you can reach me at 708-670-0595. You can also reach me on my Facebook page. That's actually being streamed live right now. So, yeah.
Wow, Mr. Owens, you have really, really, really just enlightened me. And again, even though I'm in the financial industry with you, I'm in a whole nother umbrella, but we still commingle and tangle together. And I really just love that. Again, it's about empowering. Everyone that's listening, thank you as always for tuning in. It is such a pleasure to have you all here. If you're here now, thank you. Whether you come back and watch, thank you for the support. Please love, like, comment, share the content. You never know who you're going to help. Our contact information is 312-837-7219. We are on all social media platforms under Anointed Accounting, which is ANOINTEDACCOUNTING. Our website is www.anointedaccounting.com. If you have not done so already, please go on over to YouTube. Subscribe to the page. All of our shows are there. They will stay there. Facebook would only keep them for 30 days. So, Mr. Owens, thank you again for coming out. The financial wellness advocate. That's like the perfect name for him. Because, like he said, and what I appreciate he said is, I'm not going to let you touch that. I'm not going to let you touch that. So, he's in it for the long haul. He's in it to see you win. He's not in it to win. He's in it to see you win. And like, I just appreciate your education and your experience, and you just diving into the stocks, the bonds, the retirement, the investments. Like, I'm so for it. I'm so for it. Again, to everyone that's tuning in, we got an excellent show for you next week. We'll be joined by none other than Miss Piper Parker from IRAs. We will be talking about how to make your time count as a form of currency. Like, I'm super elated about that show too. But then again, what show am I not happy about, right? I'm happy about all the shows. Like, every show I'm happy about, because we just keep learning. We keep on learning. And that's what Anointed Accounting is about. We're about learning and about educating our people, helping our people grow. Because if we don't help, who else is going to help? Nobody. Do you have any final words for our viewers and our viewers that's going to watch at a later date? What is, as a matter of fact, here's what I would like to know. If it is one tool or one piece of advice that you could leave someone that's using emotions, that's using fear, or that's saying, I'm procrastinating because of age and because of the economy that we're in right now today, that's stopping a lot of things for me. What is one piece of advice that you could give to those listeners who may be struggling with what I just said?
Yeah, so the best piece of advice that I can give is to increase your financial IQ. The more information that you have, the less fear that you have within you. So the more you learn, the more that fear starts to diminish. It was the same thing with me with this. I didn't know anything about stocks, investing, bonds, none of that stuff. So I never did it. I heard about it, but I didn't have anyone that taught this to me. So as I increased my financial IQ, that helped me to become more confident, and eventually I started investing. So,
and how would you suggest one heightens their financial IQ besides sitting down, talking to the financial wellness advocate, and of course, Anointed Accounting? What would you suggest they do on their own?
Definitely follow us. Secondly, follow us. Thirdly, follow us. But yeah, do a sit down with a licensed financial professional and make sure that they are right for you. Because anyone can call themselves a financial advisor, but make sure that they are the right one for you. And I'm talking from a spiritual point of view. You know, if you don't have that spiritual connection with that person, then they might not be the right person for you. So definitely start with that. You know, there's always information on Google, but everything on Google isn't, you know, quite accurate. So be careful with that, and just get around an environment where people talk about investing. Get around an environment where people talk about business and goals. You know, the people that you hang around pretty much defines who you are. So watch your circle.
That is the most excellent advice that I could have heard. And again, I always tell my listeners, it is okay to be nosy about you. When I'm meeting with a new client and I'm giving out information, I tell them, make sure you go back and do your research and shop around for somebody else. Don't just stop here with me.
Yep.
Keep going. Because if I'm the right fit, oh, you're gonna come back. I'm not worried about it.
Oh, absolutely.
Just like you're not worried about your money in the market, I'm not worried about you coming back. Because I know my worth. So again, listeners, viewers, oh my God, I so love you all. We're out of time. Thank you so much for tuning in. Thank you for listening and spending your Saturday with me and Mr. Owens. Thank you so much for coming out. I cannot wait to work with you more and more and collaborate with you in the future. Again, be safe. Have a good weekend. If you're celebrating your birthday, please celebrate safely. And don't forget, I like birthday cake. Bring me a piece, or I'll meet you for a piece, or just send me a gift card to Nothing But Cake. But I love you guys. Continue on with being you, and I will see you all next Saturday. Love you.